Hi there. I hope you're keeping well. The purpose of this submodule is to examine the role of the Office of the Superintendent of Financial Institutions, or OSFI for short, as the prudential regulator of the vast majority of private insurers in Canada. So let's start. OSFI is an office of the federal government that has been created by the OSFI Act. According to Section 3.1 of the OSFI Act, the purpose of the Act with regards to insurers governed by the Federal Insurance Companies Act and other federally regulated financial institutions is, and I quote, to ensure that these financial institutions are regulated by an office of the Government of Canada so as to contribute to public confidence in the Canadian financial system, end quote. From a prudential regulation standpoint, OSFI pursues the broad objectives described in Section 3.1 through more specific objects relating to financial institutions, and these objects being set out in Section 4, Sub 2 of the OSFI Act. These specific objects in subsection 4.2 translate into OSFI exercising 5 core prudential functions. So let's examine each of these 5 functions. First, one of OSFI's main functions is to ensure that federally regulated financial institutions comply with the statutes that govern them. For example, that federally regulated insurers comply with the Federal Insurance Companies Act. These statutes contain a large number of prudential requirements. For example, they require the owners of a newly incorporated insurer to inject at least $5 million into the insurer so that the new insurer has sufficient capital to support its activities from the outset, thereby reducing the risk of bankruptcy. Note that the superintendent may require an injection of greater than $5 million, and usually does. As a second example, with respect to investments and loans, the statutes provide that the directors of the institutions that these statutes govern must establish, and that these institutions must adhere to, policies, standards, and procedures that a reasonable and prudent person would implement. We will go into more detail regarding the Federal Insurance Companies Act in a later module. A second core prudential function that OSFI plays is to monitor the financial condition of each federally regulated financial institution. To this end, OSFI's activities focus on 2 main areas. The first area is to produce and publish guidelines that set out OSFI's capital and liquidity expectations. So again, the first is to produce and publish guidelines that set out OSFI's capital and liquidity expectations. And the second related activity is to assess whether each financial institution complies with OSFI's guidelines. In practice, this is done by examining 2 main questions. First, does the financial institution have sufficient capital relative to the expectations set out in the guidelines? In other words, could the institution absorb losses and continue to provide services to its customers in the event of a severe but plausible financial setback? Second main question examined. Does the financial institution have sufficient liquidity in relation to the expectations set out in the guidelines? In other words, does the institution have enough cash and assets that can easily be converted into cash to honor its financial obligations as they become due, even in the event of a significant but plausible crisis. Now, legislation governing federally regulated financial institution also specifies that in order to verify whether a financial institution is complying with the legislation governing it and whether such an institution is in sound financial condition, OSFI must, at least once a year, conduct an examination of the institution. In addition, this legislation provides that at all times, including during an examination, financial institution must provide any information in any form that OSFI requests. So this concludes our review of the second main function, which is really focusing on in the area of prudent capital and prudent forms of liquidity. A third main prudential function is to promote the adoption by federally regulated financial institutions of policies and procedures designed to control and manage risk. To this end, OSFI's activities focus on two main areas, similarly to what was discussed previously. The first is to produce and publish guidelines, and guidelines that set out OSFI's expectations for risk identification, control, and management. The second function is to ensure that each financial institution complies with these guidelines. An example of such a guideline, which is the subject of one of the videos to watch in this submodule, is Guideline B20. Now, I'd like to mention that there are two broad categories of risks that financial institutions must deal with. There are financial risks and there are non-financial risks. Financial risks include, for example, the following three risks. Insurance risk. So, for example, larger than expected claims as a result of an increasing number of forest fires. Second example, strategic risk, such as the risk of a business plan being unsuccessful. Third example, credit risk, such as the risk of loan or losses on loans rather. Guideline B20 sets out OSFI's expectations regarding a type of credit risk, that is, loans secured by mortgages on residential properties. Now let's turn to financial risks, which include, for example, the following three risks. First, a significant operational disruption due to a cyber attack. Second, a profit at all costs organizational culture. Third, turning to unregulated parties for core functions, such as cloud computing for customer records maintenance. And as you can see, a non-financial risk can easily lead to a risk to the financial health of a financial institution, including the public's confidence in that institution. Before we move on to the fourth core prudential function, I'd like to note that monitoring or assessing, if you will, of compliance with the legislation and with OSFI's guidelines can be regrouped under one umbrella called supervising or supervision. In contrast, setting expectations in the form of OSFI guidelines and setting legislative requirements can be regrouped under one umbrella called regulation. Depending on the context, the term regulation includes the supervision umbrella because you really can't have one without the other. For example, Part 15 of the Federal Insurance Companies Act is entitled Regulation of Companies. Yet, one of the headings within Part 15 is supervision. In contrast, subsection 4 sub 4 of the OSFI Act refers to regulation and supervision of financial institutions. For purposes of this course, the functions that we discussed earlier in the form of monitoring or assessing, if you will, how well financial institutions do against expectations and the Insurance Companies Act's requirements is something that we'll call supervising or supervision. And we'll go into more detail regarding OSFI's supervision powers in submodule 10D. OSFI's fourth core prudential function is to promptly advise the management and board of directors of a financial institution in the event that the institution is not in sound financial condition or is not complying with its governing statute or OSFI's expectations. This may also involve, where appropriate, OSFI turning to its other intervention powers to deal with the situation in an expeditious manner. We will go into detail regarding OSFI's intervention powers in submodule 10D. OSFI's fifth prudential function is to monitor and evaluate system-wide or sectoral events or issues that may have a negative impact on the financial condition of federally regulated financial institutions. Now, before concluding this submodule, it's important to note that the OSFI Act requires that the 5 functions that we just discussed be carried out in a balanced manner. Subsection 4.3 of the Act states that OSFI must have regard to the need to allow financial institutions to compete effectively and to take reasonable risks. In addition, subsection 4 sub 4 of the Act states that while OSFI's regulation and supervision can reduce the risk of failure, that regulation and supervision must be carried out having regard to the fact that boards of directors are responsible for the management of financial institutions, and that financial institutions can experience financial difficulties that can lead to their failure. The reminder in subsection 4 sub 4 that financial institutions can fail is particularly noteworthy. This, along with the opening language of this subsection, that OSFI's regulation and supervision can reduce the risk of failure, i.e., it does not eliminate that risk, underscores that the effectiveness of prudential regulation has limits. In other words, a policyholder or other insurance creditor does not have the same level of assurances that the institution will live up to its financial promises as a government guarantee would provide. So to summarize, OSFI performs 5 core prudential functions. 1. Ensure that federally regulated financial institutions comply with the statutes that govern them. 2. Monitor the financial condition of federally regulated financial institutions. 3. Promote the adoption by federally regulated financial institutions of sound ways to control and manage financial and non-financial risk. 4. Promptly notify an institution of its poor financial condition or failure to comply with its governing statute or with OSFI's expectations, if applicable, and intervene promptly if necessary. 5. Monitor and assess events or issues that may negatively impact federally regulated financial institutions' financial condition. So this completes the submodule on OSFI's role as a prudential regulator. Bye for now.